Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilli and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. I'll begin with sharing with you what I'm watching, and then we'll hear from Ian and Paul. And today, my talk will be macroeconomic in nature. So first off, the ongoing U.S. partial government shutdown is now the longest in modern U.S. history. Approximately 800,000 federal employees did not receive a paycheck this Friday. And the Trump administration and the congressional Democrats remain locked in a standoff. It's being reported that President Trump's budget team may be composing a contingency plan for a shutdown that may extend through the end of February. And it's worth noting that in the midst of the partial government shutdown, U.S. equities just finished 3 consecutive weeks of gains, while Fed Chair Jerome Powell is indicating the anticipation of a positive outcome with the China-U.S. trade negotiations and a more dovish outlook on interest rates. Economists overall are projecting possibly 2 interest rates increases for 2019 in June and December versus 3 hikes. Where U.S. economic data releases are concerned, we can expect to see December's industrial production print on Friday, and the consensus is expecting a step up in manufacturing output. Meanwhile, the partial government shutdown may impede the release of the results for retail sales and housing starts data this week. Now, focusing on the jobs front, something really caught my eye. It was a Bloomberg report regarding millennial women and how they're pouring into the U.S. labor force. The participation rate for 25 to 35-year-old women is up to 2000 level. And this is great news for the U.S. economy, as an increase of workers gives overall production more room to grow. And per Bloomberg, there's a new Bankrate.com survey and report, which has found that millennials are more optimistic about 2019 than older Americans. Nearly 60% of 18 to 37-year-old survey expect finances to improve this year, compared to just 35% for their elders. And lastly, I'd like to share an interesting piece I caught in the Australian Financial Review today titled, "U.S. Equities Aren't Signaling a Recession." In the article, it focuses on how the rout in equities through December's quarter weren't forecasting an imminent U.S. recession, but rather a buy signal. New York strategist and market bull Edward Yardeni, of which I've been following for some time now, is quoted as saying, "There's still no recession evident in Atlanta's GDP Now forecasting model or in our forecasts for this year. The most hated bull market in history has had frequent panic attacks on fears that most widely anticipated recession in history is imminent, and they were followed by relief rallies when the downturns didn't happen. While some of the latest data may be raising the odds of a recession, they are also raising the odds that our data-dependent Fed won't be raising interest rates in 2019 and might actually have a lowering of them, which would lower the odds of a recession and quickly reverse any flash recession that might be out there." So with that, Ian, what are you watching this week?
Thanks, Amber. So I want to start out this week by just giving a recap of what's been going on so far this year in the stock market. And specifically, last week we saw the Russell 2000, which is comprised of small cap stocks and high growth companies that are more speculative. And we saw that index was up 4.73% just last week, which was almost double what the S&P 500 returned, which was 2.61%. So we're seeing people jump right back into these growth stocks, which is a great sign going forward, because growth stocks tend to kind of lead whatever the next market move is. So people buying up these stocks shows that appetite for risk is back. So it's a great sign for the overall market. And another sign that I wanted to talk about just for a moment is the VIX, or the volatility index, which is down about 50% since Christmas Eve. So we're down to 18 right now is the overall level of the VIX. And this measures how much investors are hedging their portfolios. So it measures the option premiums on the S&P 500. And when this is higher, when more people are crowding into options to hedge their portfolios, the level of the VIX gets higher. So it was up around 36 on Christmas Eve, and then last Friday we saw it close right around 18. So these are both great signs for the market going forward. It shows that the panic is really coming to an end and that we should be seeing market gains over the next few months. Another thing, obviously, that's huge coming up right now is earnings season. And today, the 14th, is really what's kicking it off. So we're going to see a lot of huge companies reporting earnings over the next few weeks. And so I believe that a lot of bad things have been priced into the market recently that aren't necessarily true. And one of those things is a huge slowdown in company earnings growth. And I think that this earnings season is going to show us the companies are still growing. We saw huge holiday sales by some of the biggest retailers in the world. Walmart and Amazon both broke records for sales this past holiday season. And we've also seen very optimistic views from industrial production companies like Caterpillar, which is the leading production company in the world. And we've also seen positive comments from real estate companies. So I think that the underlyings of the economy are still growing well, and I think we're going to see better than expected earnings over the next couple of months.
Okay, great. Thank you, Ian. Thank you for those insights. Paul, tell us what you're watching this week.
Thanks, Amber. So I actually just finished the Profits Unlimited update, and I focused on many of the things that you guys are leading to. And in particular, I was talking in the Profits Unlimited update about, while I was actually laid up in bed sick for the last several days, the YouTube coverage of the Consumer Electronics Show. And what you saw there would make you incredibly optimistic, just phenomenally, just thrilled with our portfolio in Profits Unlimited, because you just took a tour of CES and you took a virtual tour. What did you see? Well, you saw a ton of Internet of Things devices. Every single thing was connected to the Internet. That's our Internet of Things revolution. There were so many things with AI embedded, artificial intelligence, another one of our mega trends. And there were so many different kinds of robots. Your head would spin. And when you think about it, and if you were to do a little x-ray, what you would think is like, wow, that's our chip companies that are going to be making a ton of sales. And what matters for chip companies is volume, because these are companies that build on scale, they make their money in scale. So you'd be thrilled, phenomenally excited based on what is being shown at CES for our chip companies. And so I also mention it and make it a big part of the Gold Profits Daily, where I actually recommend a chip ETF. So check out that when it comes out as well. So that's observation really number one. And then, like Ian, I'm also seeing lots of signs that it looks like stock investors started to panic about industrial growth somewhere at the early part of 2018, and they sold a lot of stocks down. And we owned in Profits Unlimited a number of these, and we sold some of them. Actually, we sold virtually all of them, and then we started to buy them back actually into the sell-off. And in fact, this morning I saw something from a large German company that's an industrial that tells me that the industrial cycle has bottomed out and is likely to start growing again, because the key was that while they reported down earnings, their stock was up. And generally speaking, that's a great sign. Another point that came up actually while Amber, Ian, and I were all together in Florida is that we were discussing a little bit the sort of state of retail. And Ian was mentioning to me that he had gone and looked up Target's earnings. And Target actually reported good earnings, and their comp store, which is comparable store sales, were up 4.7%. And we were all like, hey, well, why isn't the stock up? And this is one reason why it's tricky to be a stock picker today, because there is this whole thing of the old world and the new world. And Target sadly belongs to the old world that is slowly but surely going away. Now, they are trying as best to catch up with Amazon and doing lots of things that they can. However, the fact that the stock market thinks that Target is not doing enough fast enough, and their stock keeps going down in the face of good news is a terrible sign, because I can remember the same thing happening with Sears stock for a great period of time, really starting in the late 2000s. And you obviously know that, that Sears has declared bankruptcy. So this is one reason why in Profits Unlimited and across our services, we focus on the new stocks. Our consumer stocks, whether they be retailers, are focused on the future consumers that include the millennial generation, Gen Z, and that want a different retail experience. And that is sort of being developed, and that includes technology, which once again spins back to our chip stocks, because those will get used over there as well. So in general, I want to echo really what Ian was saying, which is I'm very optimistic for our stocks. I think we're going to have an incredible year, a phenomenal year, and I believe that we're positioned perfectly to benefit. So that's all I have. I'm going to hand it back to you, Amber.
Thank you so much, Paul. We do appreciate hearing your insights today. And I want to thank everyone for listening to this week's Market Talk. And be sure to tune in next week right here at Bold Profits Daily, where you'll hear further insights from our team. Until then, take care.